What I want to talk about today is a process that I have found to be helpful when starting a whole life insurance policy. The focus is maximum cash value. You understand the product, you have a good sense of what you want to do, but you're just not quite sure on how much you should pay into the policy. You're not sure how long you should pay into the policy. You've got a couple outstanding questions on different companies and products. What should you be looking for if you're going to borrow against the policy? Today's video, we are going to cover a process that hopefully you find to be very helpful. I found it to be very helpful, and a lot of people we work with benefit from this. So let's begin with the funding. When you are ready to start a whole life insurance policy, but you're trying to figure out how much you'd like to fund the policy with, what I would start with is a dollar range. One of my favorite questions to ask is, how much do you want the ability to pay into a policy on any given year? Not how much do you want to pay or how much do you want to fund this policy with? Because if I say, how much do you want the ability to fund the policy with? You might say, well, if things go really, really well, I'd like the ability, Steve, to pay up to $100,000 per year. However, I don't want to get a bill for $100,000 per year. So a dollar range helps us a lot, because when we prepare illustrations, if someone says, I want the ability to go up to $100K per year, we can design a policy just like what we mentioned. We can set it up where you can pay up to $100K per year, but you're only committed to $10,000. I'll provide an example on that in a little bit. But how much, and this can always be a range if you are uncertain, and this allows you to see numbers. Same thing with how long. This can be a number of years or it can be a certain age. We will discuss a couple examples in a few minutes. Next, company and product design. So around company selection, there are a lot of life insurance companies out there. If cash value is your focus, what we have seen to be true is that your four major mutual companies have a track record of delivering the strongest overall cash values and death benefits, for that matter, to policyholders. Now, what I mean when I say that, delivering the strongest cash values, I'm not referring to an illustration, which is what you will see when you're interested in a policy. You'll see an illustration that displays how much you're paying in, the total cash value, the total death benefit, and several other columns. Actual cash value refers to a policy that has actually lived the test of time, and the real results we have seen with these four companies have been the strongest. So when taking out a whole life insurance policy, where the focus is cash value, we've seen those companies deliver. On product design, flexibility is often the main topic of discussion, meaning I'm interested in a whole life insurance policy for the benefits that the cash value provides. But what I'm not interested in is having to pay a big premium or be billed every single year, every single month for the same dollar amount. Often people are not interested in that. So going back to this, how much do you want the ability to pay in? If it's a dollar range, we can set it up where it's very, very flexible. The company selection does matter here. Different companies have different rules with respect to PUA flexibility. But if I can set it up where it's flexible, commit to a small bill, call it $10,000 per year, have the ability to pay up to $100,000 per year, and then I can stop after 3 or 4 years or something like that. If I like the idea of funding a policy for a short number of years, you can do that kind of stuff. You can be creative. Next, loans. So here's the big thing to look at with policy loans. For me, I'm interested in the cash value growth. Specifically, what is my policy growing by year over year? And I do not want to include the payments I make. I want to know, what am I receiving from the insurance company in total guaranteed interest and total dividends. Then when I can see that year over year, I want to see, if I take a loan, how much is it costing me in loan interest? Specifically, what is the insurance company giving me? And then what am I giving them? And I can look at that side by side. And then also income. What you can do with income is simply look at, what is the total dollar amount you've paid to the policy since day one. Whether you paid $100,000 into the policy total, or $1 million, or $10 million, whatever that total amount is. Then when you begin to pull income, how much do you pull? Meaning, do you get more back than what you paid in? And do you still leave a death benefit, if that's something that's very important to you? But looking at income is beneficial there. So let's look at two examples here And these will be based on actual individuals or case studies that are very common. Let's take an individual, early 30s. We'll say he's age 32. This is an individual. He's a little bit older than me, but I believe he started at age 32. He was interested in getting a total of $500,000 into the policy and then not paying anything else in. He was specifically interested in funding the policy at $100K per year for 5 years. However, he did not want to receive a bill for $100,000 every single year. So, looking at these different points, funding, how much, dollar range. He wanted the ability to pay up to $100K per year for 5 years, but he did not want to be billed for that. So his minimum premium, what he's billed for every year, is just over $10,000. The exact amount for that particular case is $10,200. So he pays that yearly, and then at his discretion, he can throw additional funds into the policy. That is through your paid up additions rider, what we often like to refer to as a cash dump in. I'm just going to round here and call it another $90,000. Add the two together, you have a total of $100,000. So that's step one there. Step two, flexibility. He wanted the ability to do what? Commit to the minimum, add more funds at discretion. Of the 4 major mutual companies that give him the quality, Guardian gives a lot of PUA flexibility and also works fantastic if I'm funding for a short period of time. Call it 5 years in this particular case. Remember, one thing he specifically said was, I like the idea of getting about $500,000 in the policy and then letting it float. Just let it ride and I can use it as a line of credit as the years pass. I'm interested in that. So this worked out great for his specific case. And then with loans, he's taken loans, nothing huge at this point in time, but this is something we always like to look at. What is the policy growing by compared to what is he paying in loan interest? And then another example. Let's take someone, age 40, who wants to fund the policy at $50,000 per year up until age 65. That's 25 years. That's funding the policy for a longer period of time than our last individual for 5 years. So, same thing here, dollar range. He's quite certain that 50K is his number. When we look at company selection, a question I ask, the 50K per year, is that something that you'd like to have the ability to commit just to the minimum $5,000? So just the minimum premium and add more discretion? Or are you comfortable funding 50K per year every year? I'm comfortable with the 50K payment every year. Cash flow's there, like I can handle it. This is what I want to do. Okay, in that particular case, MassMutual works fantastic with how you can design their policies if you're comfortable with a one-time per year payment. So MassMutual works really, really well. And then on the flip side of things, so in the back end, when it comes time to taking income, what we want to look at are the total payments. So how much did he pay into the policy over that 25-year period? $1.25 million. 50,000 times 25 years comes out to $1,250,000. Then what we want to look at is how much is he able to draw down, or what's the total amount he's able to receive. So we paid in 1.25. Is he able to get out $2 million? And we want to look at that based on the present dividend rate, then also a conservative dividend rate, sometimes even the guarantees, to look at things ultra conservative. But then here's the fun part here, especially if one's concerned about a death benefit going to the next generation, is this. After I've taken that income out, when I'm age 85 to 95, when I feel I might kick the bucket, what's the death benefit that's left over to my beneficiary? Fun stuff, right? So those are two quick examples there of how we might construct a policy. And if you've seen any of our videos, you know that there's a lot more to it, particularly when you look at loans and measuring the cash value growth compared to the cost to borrow, looking at different companies, flexibility. But just a quick overview. If you're interested in a whole life insurance policy and your focus is high cash value, but you just have a couple questions or you want to know, what are other people doing? Or how do they make a decision that they are satisfied with and they know what to do and they can use that policy to the fullest over the years, I found this to be very successful. So I do hope this helps. Let us know if you have any questions at all. Please feel free to leave a comment below or reach out to us anytime. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.